In today's video, we'll be revealing 7 specific assets that provide better security and control than traditional Canadian pension plans.
Over the years, we've worked with Canadian clients and they watch their pension plans shrink or disappear altogether. And what we've seen is that smart retirees are now choosing to build wealth through assets that they control completely.
And that's exactly why we're making this video today. You'll discover 7 assets that offer a little bit more security than pension plans and why they provide better retirement security and how to use them for real financial independence.
So let's dive in.
Asset number 1. The tax-free savings account is one of the most powerful tools available to Canadian retirees. It's a tax-free savings account where your money grows and comes out completely tax-free.
You don't get a tax deduction when you contribute, but you also don't pay any tax when you take any money out.
There's also no restriction on when or how much you can withdraw, and that means you have full control over your retirement income timing. There's much more flexibility.
Yeah, and TFSAs are safer than pensions because you're in the driver's seat. You decide how it's invested. There's no pension manager calling the shots.
On top of that, the withdrawals from a TFSA don't affect your old age security or guaranteed income supplement benefits. And unlike a pension, it isn't at risk if a company goes bankrupt.
It's guaranteed tax-free income that no pension plan can match. Now, while TFSAs provide tax-free safety, RSPs converted to RIFs offer some structured income advantages that pensions can also not guarantee. And that brings us into our next asset.
Perfect. Yes. And that's when your RRSP converts into an RRIF. So this all happens at age 71. By the end of the year, in your 71st year, you must convert your RSP into a RIF, a registered retirement income fund. This gives you structured, predictable income each year.
You're required to take minimum withdrawals, but you still control how the funds are invested.
Remember, RIF income is taxable, but you can create strategies to minimize that tax that you will pay over your lifetime.
Most importantly, that RIF belongs to you, not your employer, not a pension administrator.
That means that you maintain full ownership and full flexibility. Your income doesn't depend on whether your former employer stays solvent.
Now that you understand how tax-advantaged accounts provide pension alternatives, watch our short video by clicking the link below, where we'll show you how to leverage the same principles to create your own retirement security, regardless of your current savings.
Asset number 3. Real estate can be a powerful income source in retirement. Options like REITs or real estate investment trusts can offer steady cash flow and potential capital appreciation.
Rental properties, on the other hand, generate monthly income and often rise with inflation.
On top of that, real estate also protects against currency devaluation and economic instability. It's a hard asset you can see and control.
Yeah, and unlike a pension, which can be adjusted or even cut, real estate offers long-term tangible value.
What it will also do is hedge against inflation, and that pension plans may not have.
And you're not relying on anyone to manage or maintain it for your retirement. Real estate provides inflation protection, but guaranteed investment certificates offer principal protection that even pensions cannot guarantee.
So let's talk about those GICs. They are principal protected investments with guaranteed returns.
They're also insured by the Canadian Deposit Insurance Corporation, CDIC, up to $100,000 per institution.
Now, they do provide that perfect protection against market fluctuations while you can still earn a steady income.
This is completely safe, fixed income that doesn't fluctuate with markets or depend on pension funds' performance.
So if pension plans do get underfunded, your payout is at risk, but GICs don't carry that uncertainty.
And since you own the investment directly, you're not dependent on a company or government to deliver on a said promise. GICs provide principal protection, but annuities, at the same time, offer guaranteed lifetime income that surpasses pension security, which leads us into our next asset.
Yeah, definitely glad you mentioned annuities. So just to give you some background on what that is, annuities are insurance products that provide a guaranteed income for life.
You can choose options like single life, joint life, or even for a set number of years.
Well, so what's the key benefit? I think it's that you can get predictable income, and that's no matter what markets are doing.
This is pension-style income, but it comes from a private contract that you are going to own.
The benefit of this is that insurance companies often have stronger financial guarantees than some employers may have.
Yeah, and plus your annuity isn't tied to your former job. It's tied to a legal agreement just for you. Annuities provide income guarantees, but cash value life insurance offers tax-deferred growth with additional estate planning benefits.
Great segue, John. Cash values from life insurance are that other asset. Permanent life insurance like whole life or universal life can build cash value over time.
That cash value grows tax-deferred, and you can borrow against in a tax-free environment.
So what you get is both wealth building and a death benefit for estate planning.
It's a dual-purpose asset that provides security during life and a legacy afterwards.
You own it. It's legally guaranteed, and it doesn't rely on market performance or employer funding.
Plus, it gives you options and control that pensions simply don't offer. Life insurance provides guaranteed growth, but in our next asset class, dividend-paying stocks offer income potential with Canadian tax advantages.
Often categorized as blue chip, these Canadian companies will pay regular dividends, and that's income you can count on.
And thanks to Canada's dividend tax credit, that income is taxed at a lower tax rate than most pension incomes.
Also, dividend-paying stocks tend to increase their payouts over time, which helps hedge against increased inflation.
Yep, and you're investing in real businesses, not a pension promise.
You maintain full control with the ability to either buy, sell, or rebalance at any time.
It's income with flexibility and tax efficiency built in. So now that we've seen how these 7 assets provide superior safety to pension plans, let's look at how we can help you implement these strategies in your own retirement planning.
We'll start by assessing your current pension situation and other income and identifying diversification opportunities.
Then we create a strategic mix of these 7 assets to eliminate your reliance on any one particular income source.
On top of that, we'll use tax optimization strategies like tax-free savings accounts and RIFs to keep more money in your pocket.
And we coordinate everything to ensure your retirement plan is secure, flexible, and fully under your control.
It's not about guessing.
No.
It's about building a system that works through every market cycle.
And we update that system as rules, accounts, and your needs are going to change.
Well, we should keep the focus on control, diversification, and protection, so you're never at the mercy of an employer or the government.
With the right strategy, your income stays strong no matter what is happening outside.
That was a lot, John.
Yeah.
But now that you understand these 7 assets that may provide better safety than traditional pensions, you can take control of your own retirement security.
You don't have to depend on an employer's promise or government programs to feel confident about the future.
Now, if you're looking for help creating your dream retirement in Canada using these alternatives, click the link below.
We'll show you exactly how to implement this strategy and build the kind of financial independence that traditional pensions just can't deliver.
Thanks for watching, and we'll see you in the next video.